Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely associated. Not to delay too much on the gold price, but we're going to start the show here a little bit just with the Federal Reserve. Everybody's been waiting on this news on whether or not the central bank was going to increase the interest rates again, the Fed lending rate, and they did. It was another quarter point to the 5.25 to 5.5% range, which will further restrain the economy, but not a whole lot happened as a result.
Yeah, with their determination to return inflation to 2% based on whatever calculation they're using today to determine the inflation rate. They have definitely.
Somehow they've gotten it down to 3.
Yeah, they have definitely raised interest rates again. We know that is actually true because that happened. People are starting to lose the knee-jerk reactions that we saw a year ago, obviously, which makes sense. When something is becoming a habit, you tend to not react to it like you had been. And very minimal reaction across the board here, from bond yields to gold and the Dow and everything in between. Even the dollar didn't wiggle much more than anybody would have expected it to.
Yeah.
So maybe we have achieved the new normal, the 1980s normal of interest rates are just going to keep rising until otherwise notified.
Well, that's actually kind of what he said. Their plan is to hike now every other meeting, is what we hear. So it's not like they're getting up there and they're acting like they were early on, pulling a lottery ball out of the machine and seeing what it says. They've been very transparent and very forthcoming in terms of what their plan is. So I don't think the markets really could react. I think everything had essentially been priced in for this. It was totally expected. Last I saw, it was over a 90% chance is what most pundits were saying. Whether or not that stays, we don't know. Here's the problem. Okay, CPI in July and August is going to tell them a lot in terms of whether they continue. But they bought themselves some time for that September meeting, whether they hike or not. But what they're up against is more than just that. So what they're saying is the economy is improving. That's shocking that they can say the economy is improving despite rate hikes.
Stock market's improving.
Yeah.
I don't know if we're defining the economy as the stock market.
Well, that's very common. That's the manipulation of the mindset of the average American. But really what they're up against too is the fact that prices continue to climb. The stock market is one of them. So really, they would like to see a little bit less economic activity, especially in the realm of wages. The wage growth is really what's concerning them the most and probably driving these rate hikes more than anything else, because the more people make, the more they spend. It's not just the credit markets. They can try to tighten those credit markets as much as they can. Now they really have to get aggressive in that because oil's at a 3-month high and gasoline's at an 8-month high and stronger than expected housing market, which is reflating prices. All of that is a huge problem for the Fed.
Yeah, and God forbid that wages increase to keep up with the increased cost of living as well.
That's right.
That's the part where I start getting confused, right? We're super happy prices are increasing, but really depressed that wages are trying to keep up.
Yeah, the S&P up 20% since March is great in all eyes except for the Feds. The poor retirees who are living off of their retirement, that's good news, but for the Fed, it's looked upon as too inflationary.
Right. Well, what about the metals?
What about the metals?
I had Robin here last week, and he and I talked through something that you and I and he and I have been talking about for a couple months now, and that's we know we're in a reversal period in metals in a longer-term bull market. We knew we were having a pullback. We also knew that this pullback was going to come to an end somewhere between June, July, August. I was hopefully leaning more towards August because I wanted gold to come down a little bit more.
Yep.
And we've had a really nice bounce back around in gold, as Rob and I mentioned last week. We got down to that first Fibonacci level around 1900. I had it pegged at 1908, I think. I think we got to 1899 intraday. We might have broken below 1900.
Closing just above 1910.
But turned around and come back up from there. And what I'm seeing this week is really just more of the same from last week. I still want to see gold get above the June 2nd high, which is just under 2,000. We've hit it once. We're on our way back up there. We're probably going to hit it again this week, and maybe we bust through. There's nothing between there and the old highs.
Right.
So, and I know when we were talking before we started recording, you mentioned a report coming out of JP Morgan, and I think they may not be wrong.
Well, no. I mean, they're calling for all-time highs in the next 12 to 18 months, which is, that's a pretty safe bet. That's not somebody really stepping out there. If they'd have said in the next 3 months, I wouldn't disagree with them, but at the same time, that would be a little bit more of a bold prediction. But 12 to 18 months, yes, bank on it. The underlying fundamentals continue to build, and we've said this over and over again in the show. It's not just what interest rates are doing, and it's not just what the U.S. dollar is doing. It's the economy, it's debt, it's money creation, it's Federal Reserve tightening versus loosening, it's geopolitical strains and tensions that way, it's general overall market uncertainty, it's the stock market and whether or not it rolls over. So a lot of things can take gold to an all-time high. Any one of those individually could take gold to an all-time high, much less all of those kind of happening concurrently, which we have seen a couple of times in the last few years.
So it may be that in the short run over the last few months, after gold just put in pretty significant highs earlier this year, we have had this little bit of a pullback. You look at it over the last 18 months, and clearly it's been higher highs and higher lows consistently across the board as gold continues its bull market. And we're seeing the same thing in silver. You go back to where silver bottomed in September of last year, and we've gone from around $18 to as high as $26.50 on its way back up to its previous highs from a couple years ago, up in the high 20s, low 30s. And I mentioned this over the last couple weeks. Silver, as it has come down this spring, actually failed to make its way all the way down to this rising trend line. It turned around and started going back up again. So I would argue silver is doing what I think we're going to see gold do over the next couple weeks, and that's put in some short-term higher highs. And I think there's a very good chance that silver, which peaked out back in May at around 26, I think we're going to blow right through that in the next couple of months.
It sure is acting strong, and it's coinciding with a relatively soft market. The physical market that we're experiencing has slowed down a little bit. In fact, premiums are even shrinking, coming down.
Finally.
Yeah, it's one thing for silver to be back over 25 today. It's sitting right at 25 as we record today. That's great. It's good for the silver owner. The silver buyer, the one looking to add to ounces, would rather see it lower. But you're not being stung because the premiums are tightening. You're not overpaying for something.
Still too high on some products, but
for sure.
Nowhere near what it was a few months ago.
And that's a very welcome market phenomenon.
Yes. On the flip side, we have, I think you and I were talking, a couple weeks ago in here, and I'm like, I'm done with platinum.
Yeah, you were.
I don't,
platinum.
Yeah, I don't know.
Look at it though. It's
higher highs and lower lows.
Yeah.
We put in a higher high and then we put in a lower low. It doesn't know what it wants to do. And that doesn't surprise me because I think the uncertainty is built in from the political side when it comes to platinum. Because you look at platinum mining globally and you're talking South Africa and Russia constituting the majority of platinum production globally. So with political uncertainty in a place like Russia and sanctions and all the other things that we're having to deal with, Russian-produced raw materials probably finding their way into the open market via China, who's taking a little VIG off the top and melting the bars down and recasting them with Chinese symbols on it. Whatever you got to do, right?
Well, like the Russian gold market.
Yeah.
So their gold reserves have to make their way out somehow. And I don't disagree with you, Miles. Commodities in general, to me, are still undervalued, still underpriced. What you tend to see is commodities soften while equities go into a bullish pattern. Mm-hmm. And that's exactly what's transpired this summer. You've seen the equities markets hot, commodities cool, and the commodities were underpriced going into this equity market rally. So at some point, you're going to see a reversal, and those patterns tend to last for more than a few months. They often last for a few years, and that inflation is going to work its way through the system. The Federal Reserve knows, and that's why they're continuing to hike the interest rates, because it's not just about the current metrics. It's about what they fear the future ones will be and the future prices. Technology soaring, that's driving the equities markets as well, but it also is going to drive platinum, palladium, silver, those white metals that are used so heavily in the technological sector.
Yeah, and the interesting thing about how commodities move, and I'm thinking case in point about 2 years ago when the lumber market just kind of exploded up. You go to Home Depot to grab a 2x4 and it's not $2 anymore, it was 12. And sure, it came back down, but it didn't come back down to 2. Came back down to 8. So you get these massive leverage pushes up in commodity pricing. You have this long-term inflation line pushing the value of the currency down. But you don't have equivalent movement in the commodity market. It's not like the dollar goes down 10%, commodities go up 10%. It's not linear. You tend to have these periods of time where the dollar will inflate over time, and then eventually the commodity market hits a breaking point where they have to rapidly adjust prices or shut down mines and shut down lumber mills and lay off employees. So they hang on as long as they can, but you'll have these step-up periods where the prices step up. And I think that's a fair argument going forward, that as this continues, there are going to be periods of time where, like, say, silver did in 2010, where silver does more in 9 months than gold did for the whole 2-3 years prior to it.
Right.
And I think we'll see platinum do the same and other metals as well. And it's unfortunate when you're talking about copper and lumber and nickel and tin and all the things that we have to use on a daily basis.
Those are the things that drive up the prices of the things that we consume. We're not consuming gold, silver, and platinum. We're investing in them and we're holding them. Unfortunately, the ripple effect is that. Same thing with oil. We're seeing oil have strong prices. Our reserves are depleted. Oil is a very strong sector to me, a ton of potential, even though it's at $78. That's nothing. And unfortunately, that's, again, a consumption type commodity because we may be consuming it through our vehicles or whatever else, or our heaters, but it's something that really affects the pocketbook, the monthly budget. And that's why you need the gold, silver, and platinum investment to make you numb to those climbs as they all climb together. That is your savings, and that's the whole point of doing it. And in the meantime, if we can compound ounces through that and get some fluctuations, the gold to silver ratio is down from 86 down to 80 because of that outperformance of silver that you've talked about here. Where does it go? Do we get to finally see a sub 60 ratio, or are we going back over 100? That's something to play out in the next 12 to 18 months, JP Morgan.
Well, and that's a really interesting point to bring up because I think it solidifies something you and I have talked about for years. And self-plug here, forgive me for the company, but it just kind of makes sense to work with somebody who's been following these markets for decades, because you want to make sure you're not reacting to what we think the market may do. Because you don't really know, right? You don't know if the gold-silver ratio is going back to 120 or if it's dropping to 35. But there are ways that you can work with somebody who can help you navigate that stuff. So for our clients who are listening, or anybody who's ever thought about maybe giving us a call, I think it's worth sitting down and talking with somebody. You know, one of the analogies Rob always gives is if you're buying a plane, you can fly it yourself or you can hire somebody to do it for you. And sometimes it makes sense to catch a pilot as well, because there are things you want to make sure you're navigating as you're going through the waters of how the metals not just interact with the US dollar, but like you just mentioned, how the metals interact with each other, because nothing increases your investment position more than just flat out increasing the investment position. What if you don't have to sell something to cash and then wait for a re-entry? What if you can swap between products when it makes sense to do so and just increase your position?
Yep.
Yeah. Add an extra 30, 40, 50% in metals at cost or for free if you do it out of other metals. Because I don't know what else you do nowadays. I love the fact that the equities market is going up. I still don't trust it. I don't trust the Dow. The Dow's been screaming for the last month. But
yeah, they could go to all-time
it.
highs, and I still won't believe it. It won't matter to me because it's this impending correction that matters more, unless you just are perfect in your exit strategy and have a timing issue. But at some point, the U.S. dollar decline will impact equities as well. So as the economic outlook improves, if the central banks around the world are actually effective at driving a little economic stimulus without easing, well, then you'll have less of a need for a safe haven currency, namely the U.S. dollar. That, combined with the European Central Bank and the Bank of England right now doing a lot more aggressive tightening, is strengthening those currencies relative to the dollar, and it's driving the dollar down. We have a lot of downside on the U.S. dollar, which we haven't even really talked about yet. But looking at the U.S. dollar, that can also drive equities a little bit higher. But they're not nearly the hedge that gold is. So as the dollar declines, you'll almost see this inverse relationship. And that's really where all eyes should be, is don't watch the equities markets, watch the U.S. dollar.
And what concerns me there is today the dollar is more attractive than it was yesterday for foreign investors. And what did the dollar index do? Nothing. What did Treasury yields do? Nothing. So the dollar is more attractive today than it was yesterday. And we knew this would happen. We knew there would be the knee-jerk reactions when things first started moving, and then people would get used to it. People would get used to being trapped in the pen, and they'll stop kicking against the goads and eventually calm down and just say this is the new normal. So maybe this right here today, this interest rate rise, being that there's almost no reaction to it across the board, maybe today's the new normal.
Well, that's going to do it for this week's Golden Rule Radio. As always, we appreciate you listening. Please give us a call. We'd be happy and honored to walk through your individual portfolio with you and provide any hows and whys and suggestions. And that number is 800-525-9556.
You can also find more info on our website at McIlvaney.com. We're on Facebook at McIlvaney Financial and on Twitter at ICA Gold. Thanks again for listening and have a great week.